All right, Charlie. Good afternoon. I think we're live, so we'll give everybody a few minutes, or maybe a minute or so, to trickle in. But thanks for joining us again. Good to see you.
Yeah, you too, Caleb. Always a pleasure. It's going to be a lot of fun.
We've got an obscure topic today, something nobody's been thinking about, so it'll be fun.
Yeah, for sure. No one's asking about AI and whether it's a bubble. Definitely not. No, that's the number one question. That's why we're talking about it.
I'm looking forward to it. Let's go ahead. I guess we can get into some housekeeping items and kind of get going here. So again, welcome everyone. Thanks for taking some time out of your Thursday to join us. I've got Charlie here with me. If you don't know who Charlie is by now, you probably should. Make sure you're following Charlie across the socials. This webinar will be shared to everybody, so you'll get a recording. But also check it out on YouTube and make sure you subscribe to our YouTube channel so that you get content like this automatically in the future as well. Obviously, want to remind everybody that we are here for educational, maybe some entertainment purposes, but not for formal investment advice. So please don't take anything we say and run out and make any big decisions without researching those first. But if you have any questions, we'd love to get to some Q&A at the end of our session today, as well as tackle some of those questions as we go. There is a nice Q&A module connected to the Zoom webinar interface, and you can type your questions right there, and we will do our best to answer those. But let's get into everything. So, quick agenda today. We're going to talk about obviously AI and whether or not we're in a bubble. What better way to start than defining what a bubble is to make sure we're all on the same page? Then we'll look at some of the warning signs. We'll look at some of the pushback. The other side says maybe it's not a bubble, and then we'll give some get some great advice from Charlie on what you can actually do to protect yourself or prepare for what this might mean. So, if it's okay with you, Charlie, we'll get right into it.
Let's do it.
All right. So, what is a bubble? What better way to define it than to look at some of the experts that we've all learned to respect over the years and see how they defined it. So, let's start with Robert Schiller. Go ahead, Charlie.
Yeah, Robert Schiller, one of the greats, won a Nobel Prize for economics for his thoughts, and really he had what I would say impeccable timing when it comes to talking about bubbles. He came out with his first book called Irrational Exuberance right before the peak of the dot-com bubble back in 2000. And then he follows that up with the second edition right before the peak of the housing bubble in 2006. So pretty incredible from the standpoint of timing there. And really the way he defines it is just talking about a social contagion. He's talking about the psychology of it. Caleb, right? You're hearing it from your neighbors, you're hearing it from your friends, you're starting to envy all of the winnings that they're talking about. And that creates this feedback loop where you want to go out and speculate. And that just goes on and on and on until it doesn't, right? Until you hit that maximum point of optimism. And then that's the peak of the bubble. So really, it's really from a psychological standpoint, he's saying is really why bubbles are created.
It seems like the counter of what you would do if you thought we were in a bubble, though, right?
Oh, for sure, right? You would you would see everyone else losing their mind, and you would say, "I'm not jumping in. I'm going to resist it." But that's very hard, as we know what to do,
Yeah,
because
let's keep that in mind.
the greatest fear is the fear of missing out.
And what about Cliff Asness? What do you say?
Yeah, so Asness, famous quant, and obviously he takes more quantitative approach here, and he's kind of trying to say, well, is it based on valuation? Is there a way you can kind of say, well, this is so incredibly crazy, the price is so incredibly high that even if I take the most charitable position, even if I assume the best things about the future, that there's really no way to justify this. And what he's talking about here in this quote is simply tech stocks in early 2000 saying, unless they were to grow their GDP to be as big as the entire world, then you can't really justify their valuations at the time. And here's just one example of that. Looking at one of the biggest stocks back in March 2000, Cisco Systems, incredible company, had an incredible fundamental run during this period of time, but people's emotions drove it up to such an incredibly high valuation here. We're looking at over 240 times earnings, just an incredible expectation about the future. So even though Cisco Systems, Caleb, would do very well over the next 25 years, you look at where it is today, much higher net income, much higher revenues than back in 2000. Its valuation was just so incredibly high that as Asna said, there was really no way to justify it at the time.
And I think it took about 21 years for the stock price to get back to where it was at that peak, right?
Yes, and even today it's like right around there. If you adjust it for dividends, it's higher, so a little bit higher, but it just shows you how important when you have these extreme valuations, how important that can be to long-term returns.
All right, let's look at another viewpoint. Eugene Fama.
Yeah, Fama, the efficient markets guy, he really coined really the efficient markets hypothesis, which is essentially saying that prices are reflecting pretty much all information that's out there, and so therefore what you're seeing in the market is efficient. So no surprise that he believed that really bubbles are hard to quantify and hard except for after the fact. So what he's talking about is absolutely true that there's always people saying that prices are too high, but it's only after the fact that you actually know that they were too high, and therefore, since they're not predictable in his view, then he's saying most bubbles are simply 2020 hindsight. So, interestingly, he won the Nobel Prize in economics the same year as Robert Shiller, and so they shared it, even though they had opposing viewpoints on prices and the efficiency of markets.
This is interesting, Charlie. We looked at three different, renowned experts. One saying this is an emotional response that drives prices up to, you know, beyond what's reasonable. Another saying it's a term that can be used to capture when prices are, so inflated that future conditions could never support them. And then another saying that it's just hindsight, right? Like this happened. What do you think? Like how would you define a bubble? And is it possible to be in a bubble and also think you're in a bubble, or does that, based on what Fama's saying, kind of disprove it?
Yeah, I tend to side with Schiller and Asnes, but I think elements of what Fama's is saying is absolutely true in that even if you do acknowledge that bubbles exist, it doesn't mean you know when they're going to burst, right? So that part is definitely unknowable until after the fact. And he's absolutely right that people are constantly using the term bubble, and many times they're wrong about that, right? They use it very loosely. And then it's only when it bursts that they say, yeah, you see, I was right, but all of the failed predictions aren't talked about. So I think it's some combination of the three. But if I have to pick two of them, I'm going to pick the combination of psychology is creating it. So definitely, as human beings, Caleb, we know we've seen manias. People get crazy. We've seen evidence of that, and there is a way. I think when you're looking at stocks or you're looking at housing, to say this valuation is simply so high that even if everything went right, even if in the perfect scenario, you would still have a hard time making a return on your investment because of those expectations are so high. So I definitely think bubbles exist. We've seen them. So I'm going to pick like a blend of those two. But for Fama, 100%, you don't know when they're going to burst.
So one thing's true for sure, which is we've seen bubbles in the past, whether it was, again, something that was more obvious after the fact or, something that you could have sensed going into it. But these are some of the most notable bubbles we've seen in the past, right?
For sure. And they're not all the same. Like you have some, of course, like a tulip mania where it's, of course, there's no fundamentals at all and you're just speculating on the price of something. But there's other bubbles that have a lot of underpinnings that are real, right? Obviously, a railroad was a huge transformational thing in this country. So naturally, people are pouring money into it, there's investments into it, and that just gets to the point where people's expectations get too high. Same thing with the Roaring Twenties, same thing with Japan and its asset bubble, same thing with the dot-com bubble. All of these things had things behind it that were going very well, that created a great story, getting back to that psychology picture, a great thing for people to kind of have that feedback loop because of it just got so extended that going to Asnus's point, it got to a point where it was just simply too high in terms of valuations. But in every one of these cases, Caleb, people were screaming bubble before that bubble actually burst.
So let's take a quick poll and let's see if people are screaming bubble right now. So we're gonna put a very simple question out there for everybody to answer, which just asks, are we in an AI bubble right now? And while we give everyone a minute to answer that, we'll jump forward and look at what was the resulting scenario, at the, I guess, peak to trough impact of these bubbles that we saw in the past.
Yeah, so not good. This is why everyone is worried about a bubble. They're not worried about it because it's going to inflate further. They're worried about it because maybe it's going to pop now and then maybe we're going to see big declines like we did in the past. And depending on the bubble, we've seen an almost complete loss. If we look at the tulip mania, we see 90%, 80%, 70%. The housing market, of course, 30% nationally, but many areas were down 50, 60, 70% within the US. And most recently, one of my favorites, the meme stock mania, which pretty much all of them went down 90+%. And it's still going on. It's like
That
a
was your whole
series.
portfolio, Charlie.
Yeah, yeah. It's a series of rolling manias in the meme stock. Like even this year, a few months ago, we had just a new crop of meme stocks. So these are the major ones I would point to, but certainly there's mini bubbles happening all the time.
And I guess one thing that shows here, right, is all of these bubbles that happened, and I think you mentioned were at least at some point somewhat predictable and did have a big drop from the peak to trough. Charlie, any recent or even further back recollection in your memory of bubbles where people said there was a bubble or there was a lot of hype around a bubble where we didn't realize this kind of big sell off soon after?
Yeah, and I would give two examples there. Not that they didn't have big sell-offs, but that they actually came back from those sell-offs. So the first example I would give is during that 2021 mania, it wasn't just the meme stocks; it was everything, right? It was crypto, it was the Mag 7 names, and similar fears to today. It was pre-AI, but uh, similar fears, and you had valuation fears, and we'll talk about that in a little bit. And then we had a 27% bear market in 2022. We just fully recovered from that in early 2024 and then went significantly higher. So we're about 50% higher in the S&P than those peak levels back then. But in the interim, we had a big correction. So I would point to that. And then I would point to Bitcoin, right, which I would say has had a series of rolling kind of bubbles. Like it goes through a mania phase, then it goes down 80%. It's done that a few times. It did it in 2017 after its peak. It did it after its 2021 peak. It went down 80%. So many times people say, it's a bubble, it's a bubble. And yeah, it was a crazy, crazy, unrelenting move higher. And then it would go down 80%, and then it would recover. So, like, even though something you could say it's crazy, it's irrational, it's going up very much, you don't really know how it's going to play out in the end. So, like, we know how these things played out. Like, we know how the dot-com bubble played out. It went down 80%. We're looking at tech stocks. It took many, many years, sometimes decades, for a lot of these stocks to recover. Sometimes they never recovered. But we know the market as a whole did recover, right? And the housing market did recover after the housing bubble. So just because you have a bubble, that doesn't necessarily tell you what's going to happen next. And it doesn't say that the market or whatever asset you're looking at won't ultimately recover and then maybe go on to have an even bigger
Sure, higher
bubble.
highs, right? Higher highs, higher
Yes.
lows.
Yeah.
Well, let's look. Let's see what everyone attending today's webinar thinks about whether or not we're in a bubble. Can we get those results up? Can everyone see that? I know I can see it, but Charlie,
Yeah,
can you see the results?
yeah, it looks like
Looks like
about a
we're
third saying a bubble, about a third no, and a third I don't know. Uh, taking
but
hedging
more
their
no
bet.
than yes. So hey, some
More no than
optimism.
yes. Yes.
All right. Well,
Yes.
let's
But
look at
that sounds about right to me. in terms of
It
the
definitely also
percentages.
matches, I guess, what we're seeing from kind of investor behavior, right? With still, positive investment flows. But
Yeah, that's true. If everyone thought it was a bubble, then probably we're already
yeah,
going down.
self-fulfilling prophecy, right?
Yes. Well, that's the interesting thing, Caleb, before we talk about some of the warning signs is the peak mention of the word bubble isn't at the peak of the market. And there's been many studies of this. It's in the aftermath. So if this is the peak, way more people will be using the word bubble next year, the year after, right, as it's going down, because as we just talked about, now you have hindsight, and now you can point to it. So,
Sure.
yeah, just an
Makes
interesting one.
sense. Well, let's look at some evidence. So, some of the warning signs that maybe it is a bubble. Let's start with, I think Schiller's favorite, ratio.
Yeah, the CAPE ratio, which is just simply smoothing earnings over a 10-year period, adjusting for inflation, and then taking current prices. And I think this is probably the strongest argument you can make to say that if it's not a bubble, there's definitely elements of froth because other than the 1999 2000 period, valuations haven't been this high. And this is just one valuation indicator, but we could pick 10 different ones and they all show that same thing, that valuations in terms of US equity market has not been this high since that dot-com era.
And I guess one specific example here, we've got Palantir trading at a pretty high multiple.
And this would be one of the most extremes, and which is why I picked it because you have some people pushing back against that last chart in terms of the CAPE ratio, saying, yeah, we're back to 99 2000 levels, but we're not seeing like crazy speculation in names were similar to what we saw back in 2000. I argue we're seeing a few of them, Palantir being the biggest one. This is its forward PE ratio. So we showed that chart of Cisco earlier, which was showing trailing
Trailing.
earnings at this similar crazy valuation. This is looking at future earnings, so expecting earnings to be higher a year from now. It's still trading at 240 times forward earnings, which is something I've never seen before for a company this big. We're talking about 400 billion or so market cap. So there's definitely evidence of people thinking that valuations don't matter. Let's just buy this thing because it's associated with AI.
Yet price target, I think, is still higher by these same analysts, right, than where it's trading right now. So,
It
how,
always
how,
is. That's right.
so how do you think about looking at like an earnings season, coming up? When you have these big valuations in the market, are you just looking for earnings growth to say, hey, that's a good sign, or are you looking to how people react to those prints?
Yeah, that's a good question because there's also this kind of myth that earnings weren't growing and earnings weren't strong going up to the 2000 peak. So you hear a lot of people say, well, those weren't real companies. Now we have real companies with real earnings, but that's pretty easy to dispel. You just go back to that period. Earnings growth was, as you might imagine, incredibly strong right until the market peaked. So the way I look at it, Caleb, is are earnings growing faster or slower than expectations, number one? And two, are valuations expanding or contracting? And what we're seeing once again this year is earnings growth is pretty strong. If you look at what analysts were projecting right before the earnings season, definitely beating those expectations. And in the third quarter, we pretty much have all of the S&P 500 reporting at this point. We hit another record high in terms of earnings. They're up about 13% year over year, which is almost double the historical average growth rate. You had profit margins hitting record highs in this third quarter as well. And so people could look at that and say, well, you see, earnings growth is strong. It's going to continue to be strong. And that's why we have these high valuations. So essentially justifying it, as we'll talk about in the pushback section.
Yeah, and we'll also talk about a slide. We've got a slide coming up and a couple pictures here that, I mean, you can't have huge earnings when you have huge spending and huge spending increases. And there's definitely a bit of an arms race going on and a lot of spending, especially on, technology spending and hardware. So,
Yeah.
we'll get into that in a little bit, but you probably expect to see these PE ratios expand and some of these earnings growth numbers slow down in eras of extreme spending too, right?
Well, yeah, we could talk about that now. Like that is going to be the big question in terms of the spending. Like, is it being accounted for correctly in terms of this AI spend? Does it have a shelf life of 2 years, 3 years, 4 years? And people like Michael Burry, Big Short fame, who's been out very vocal recently, calling this a bubble, clearly betting against it. This is one of his short positions. If you look at his most recent filing in terms of Palantir, and he had others in there as well. But what he's saying essentially is the lifespan of these investments is far shorter than what these companies are assuming, which means that they're depreciating it over a longer period, which is making their current earnings look better than they actually are. And we won't know. I think it's a valid concern, a valid point to bring up, but we won't know until hindsight that whether this is something that's real, what is the lifespan, but it's certainly a valid argument to be suggesting, okay, we're calling into question now this earnings growth that is really strong. And of course, looking at the valuations of things, it's hard to argue against that part of it. But as everyone knows who's watched The Big Short, he was painfully early in calling that bubble in the housing market, ultimately very, very right, and made a lot of money for himself and his investors. But could this be another example where he's right but early? Of course, it could be.
The next chart here is really interesting, right? Because we're looking at basically how big of a position in what would supposedly be a diversified index, right? A few of these companies have, and what that means as far as exposure to this risk, right?
Yeah, so it's interesting, Caleb, because you'll have people saying it both ways. Some people are worried about this, the concentration risk, because now you have 10 holdings in the S&P 500, over 40% of the index, with data going back to 1980. This is far and away the most concentration that we've seen, and it's really tech and AI leaders that are driving this. And so, on the one hand, you're only going to see this during a period where people are so excited about a small group of companies. And really, the perception is, maybe it'll be right, maybe it'll be wrong, is that these small group of leaders are going to get the lion's share of gains from this AI revolution. And so far, that's been true. If we look at earnings growth for these companies, far outpacing the rest of the market. But then there's people on the other side, which is interesting as well, where there's saying, well, do I have enough exposure to AI? And maybe they're not looking through their holdings, but if they're just owning the broad US market, you have pretty good exposure in just the weightings alone in terms of the technology sector. And that's not including energy, utilities, other areas, obviously real estate that are being used for AI as well. So I think the exposure is probably bigger than most people think in terms of AI.
Does some of that question though come from the concern of being exposed to things that will actually be hurt a lot if a lot of the AI, advancement does come true, and we see a lot of, replacement of, people and, functions with machines and machine learning.
Yeah, you're saying concerns about the other stuff that's not
Right,
in.
right. So
Yeah,
if, these companies grow into their valuations, does that mean everything else is, in a bad spot?
I don't. I don't have that view because I think if it's such a revolutionary technology, it's going to spread to smaller companies and they'll be able to use it and be more productive and more efficient. So I don't have that opinion. Clearly, that the market is betting that way today, and it's been right to believe that the last few years if we're looking at the increase in concentration here. But ultimately, I don't see how that would make very much sense that only these few small companies are going to benefit from. If you just look at the internet, right, and the dot com era, like all companies benefited, right, ultimately from that.
All right. Next chart, looking at expectations for future earnings growth. So we talked about this a little bit already, but a slightly different lens here.
Yeah, so I like to compare. Just take a look at the Mag 7. What's their weight in the S&P 500? And this is a record for the Mag 7. They're at 36%. It was only a few years ago. They were only 20%. So they're over a third of the index. And they were a fifth of the index just a few years ago. So what we're looking at here is comparing that index weight, 36%, to their share of net income. And if they were equivalent, Caleb, you would say it's hard to say that we're in a bubble because it's market simply reflecting what the actual underlying fundamentals are. But you can see there's a gap here, and people argue whether that's a huge gap or not. But the combined net income is about 27%, and 36% is their combined index weight. And so there is a gap, and that gap is that simply that expectation, right? These leaders are going to continue to lead. They're going to continue to have higher profit margins, higher earnings growth, and that justifies them taking a bigger share today because that net income number is going to grow faster than the S&P 493.
What do you typically expect to see here? I know you said this is a large gap historically, but what's a normal gap?
I don't know if there's such a thing as normal, right? Because there's
Yeah.
always different market environments, right? But clearly, this is more stretched than it's been in a long time. You have to go back to that kind of 2000 era to find this type of gap. But that some would say that's understandable given how much faster the earnings of these seven companies have grown versus the broad market. So it really comes back to that. Do you think that earnings growth will continue? Do you think that their profit margins of these companies, which are enormous and far higher than their competitors, are going to persist, or there's going to be competition and companies are going to come in, particularly for Nvidia? That's the big question. Can they continue to have 50+% net profit margins on on what they're selling? That would be unprecedented historically for the type of business they're in, but that's what investors are kind of assuming right now.
All right, so this chart goes into the topic I got a little excited on and brought up early around just the spending and the huge growth in these capex numbers for these big companies. But anything
Yeah.
else that you wanted to add on here that we didn't already
Well,
talk
I
through?
just want to, yeah, point to the numbers here, like how incredible. It's 3 years. We're talking about 229% increase in capex for Google, and Microsoft is 208%, and you got Amazon and Meta. And these four companies alone, Caleb, like take everything else out and just pick these four companies, you're looking at 400 billion in annual capex spending at this point, 100 billion a quarter. It's crazy. It's crazy, crazy increase, far above where we were. I think it's 4x higher than where we were 5 years ago. So you got a 4x increase in capex spending in 5 years. And ultimately, this question is the biggest one out of all of these. Like, is this investment warranted? Is this investment going to last the 5, 6, 7 years that they're saying it is? Or are they going to need to re up in 2 years because these chips will be obsolete, right? And then need to pour even more money into this stuff? And nobody can answer that question. Clearly, it's an arms race. Clearly, they're behaving as if there's so much urgency that they have to ramp this stuff up by enormous amounts. And these were all capital, light businesses, right? And that's what made them so valuable. These were software businesses in many ways, and that's where they obtain their value. And now it's shifting, which is very interesting, into this more capital intensive area. And investors are betting that's going to pay off for them. But I would argue that's something very different. And we're just starting to see, not necessarily with these companies in particular, but other companies like Oracle. We're seeing in OpenAI as well in the private markets. We're seeing debt start to be introduced in terms of how are they going to pay for all this capex? Is it just going to come out of existing cash flows? Clearly, these four companies can just take it from cash flow, but there's an incentive, obviously, to take on debt, and that's what's occurring as well. And that adds an additional layer, I would say, of risk in terms of this capex spending.
Charlie, one of the questions that came through is around kind of the concept of monopolies and these large companies, and especially how they're capturing so much of the market share in an index like the S&P 500. You talk about that spending and the fact that can this spending persist? One thing that is I think not debatable is that only a handful of companies can spend money like this, whether they're financing it with debt or not. And it is probably creating a barrier to competition, despite the fact that we have new technology that you would think would be disruptive to these big technology companies. How does that play into these companies having the ability to just to continue to get bigger, or do you see any type of regulatory concerns that could also get in the way of some of the growth of these large companies?
Yeah, for sure. There's always that concern, and I think this is this is a time period where both parties are kind of united in saying like these companies have become perhaps too big, but I'm not sure that's what's going to ultimately end this type of spending. I think it'll be whether they're actually seeing the results. And what ended it back in 2000 is simply the economic environment. It changed, right? So you had all of this business spending back then going into companies like Cisco, and then we went into a recession. And what do companies do in a recession? They start to pull back. So all of the assumptions that we talked about so far, valuations and growth, and like even for this stuff, it's all assuming the status quo in terms of the economic environment, that everything is going well enough where companies are feeling good about the future and growth is strong and demand is strong and the consumer is strong. There isn't high unemployment or other things going on. We're seeing a pullback. And we can't say that's going to be the case for sure. There's always a possibility of an economic downturn. So I think that to me that's a bigger risk. I think these companies have become so incredibly powerful that they're spending a lot of money on lobbying and everything else. It's very hard for me to believe that they're going to give up that powerful position anytime soon. Doesn't mean small things here and there might not change with some of these things, but I don't view that as the big risk. And if the U.S. wants to be the leader in AI, as we've seen, they're going to have to be more lax in terms of regulations because we know China is not holding back whatsoever.
Well, there are some small companies that we're seeing get big valuations too, right? I mean, we're seeing this phenomenon a little bit still of these companies with no revenue or not a whole lot to show from a financial success standpoint getting big valuations.
Yeah, for sure. Oklo's, one example here. It's not an AI company, but it's like a nuclear energy company that they're going to need different forms of energy to power this AI revolution. It's an interesting concept. People can go and read about it, but it's not yet produced $1 of revenue. It recently hit close to $26 billion market cap, and since then it's been cut in half. I don't know what will happen from here, but there's examples of these companies going on now, just like we saw in the dot-com era, where anything related to what people are excited about is getting that bid, and it won't all be justified, right? But you only have this type of rampant speculation going on during a potential bubble.
But there's risk appetite.
Oh yeah, and we're seeing it in so many different places. If people are watch sports right on Sunday, I was just going to say Sunday, but now the NFL's on pretty much every day. It seems like um, yeah, every other ad is for some gambling, promoting some type of sports gambling, and I just think the environment for risk appetite is extremely high. I think 2021 would be the last year, I think, where you could see this risk appetite being this high. This is just one example here in the public markets, looking at a filing recently for 21 5x levered ETFs. And if you look at some of these names here, they're extremely volatile without putting any leverage on it. So strategies in there, the micro strategy, the Bitcoin treasury company, that recently was down over 60% from its peak. You got, of course, Nvidia and Tesla, Palantir, all the high beta names. Plus, you have crypto, Bitcoin, Ethereum, Solana, and you have gold, right, and gold miners and that stuff. So basically, what people are saying, if this is approved, is just like legalize gambling here, where a 20% move in one of these things will completely wipe you out. And I think not a good thing. I don't think it should be approved. There was an AMD ETF recently. It was a 3x short that was trading over in the UK. and it went bust because AMD gapped up over 33% one day, right? So it's not theoretical. If you approve these things, it's going to happen. But I'm just using it as kind of a broader sentiment thing, getting back to what Schiller was talking about. Everyone's telling each other about the gains they've made in these names, and that's why companies like volatility shares are they're seeing demand, right? People want to lever that up. So when you see an extremely high return, many of these stocks up thousands of percent over the last decade, if you have that fear of missing out, say, why not just go 2x, 3x? And you would think that would be enough, but it's never enough, right? The 5x. And this is just within, the equity market, so to speak. In the crypto market, it's way more extreme. We have like perpetual futures now being traded that go up to 100x leverage that were recently put on platforms like Coinbase and other platforms. And their 1% move is going to wipe you out, right? So the only the only way you see these things come to market is for people to believe that risk is so low that I might as well just take as much leverage as possible. So you never see this type of stuff going on in a bear market. Go back to 2022. No one was talking about levered Bitcoin exposure because Bitcoin was down 80%, right?
Yeah. Yeah, and it's a little bit of a, I mean, if you go back to the housing bubble and the fact that people were able to get some of those high risk mortgages and margin accounts back in the late
Yeah,
90s, right?
any bubble, oh, right, always becomes a credit bubble in the end because it almost has to from a sentiment standpoint because if you're viewing these gains as irresistible, the next logical step is to borrow money to leverage that return, right? And 100% in the housing market, people have multiple houses, right? That they couldn't
Right.
afford one of them, but they had multiple houses.
All right, so it's a compelling argument. We've got extreme valuations, we've got high concentration of a handful of companies in major indices. We've got spending that we've never seen before and growth in that spending. We've got, some I guess revenueless companies that are trading at high valuations, and we've got a big risk appetite. So some compelling arguments, but let's take a look at the other side. What's some of the pushback that says, hey, maybe everything's going to be okay?
Yeah, one would just be this is real. We're not imagining this stuff. So it's not a tulip mania in that there's nothing real about this. It's clearly real. Different models have projected how real it's going to be, but no question it's going to make the average worker much more productive. And this is just one model saying really the bulk of that productivity is actually going to happen from here. So we haven't even seen it yet. But in the next 5 years, you're going to have a huge increase. It seems small, a few percentage points here, but it's actually, if this were to happen, you would see a substantial contribution to GDP, to the earnings of companies. If the average worker is going to become way more productive than ever before because of this, and this is the assumption of not just this model, but many models, then it's clear it solidifies the argument going back to valuations to saying, well, maybe this time is different because the growth from here that's going to be generated from this is just simply something we haven't seen before.
And I think we saw that with, when you talk about the dot-com bubble, and I mean, the internet changed things forever, made, a lot of companies more efficient, but we still saw that big drawdown, right? And it took a while for, I guess, that economy to mature and grow into that technology. So even if this does happen, I guess we could probably still see some pain between now and realization of this, right?
Yeah, for sure. It comes back to the price you pay, right? So if Palantir doesn't grow at like 50% a year for 10 years, like it doesn't matter if everything they're doing is way more productive because there's just going to be a reset in terms of expectations. So it's really trying to predict, well, what will that future multiple that investors are going to pay? What will it be 5 years from now, 10 years from now? If you tell me it's going to be the same, that people will be as optimistic, well, then it's just a question of, well, how much earnings are going to grow between now and then, right? That's the only factor, right? But if you're telling me they're not going to be as optimistic 5 years from now, because maybe we've reached the peak of this productivity growth and they're pulling forward the returns from that today, well, then that's a different equation because then you have multiple compression, you have slower growth rates going forward, and the market's starting to think about. So it's a complex kind of back and forth. But you're right. We could see everything that people are expecting in terms of it being revolutionary, but still not see the investment returns being as good as they've been because you could have expectations change.
And another way to look at this is that we haven't realized the value of what's being built and being developed, right?
Yeah, for sure. And that's 100% true for most small companies. This is a chart just simply showing by company size what is the adoption within companies. And they're saying even large companies, it's only like a little under 14%, but a lot of smaller companies, it's half that perhaps. So this is hard to measure and it's changing very quickly. But I think the broader point is we're in the early innings of what people are going to use this for. People are just starting to figure out. I know the adoption is much larger for people personally, right? They're using AI to answer questions that they used to use Google for. A lot of people have ChatGPT or other apps like that on their phone. They're using that more and more. But in terms of the average knowledge worker using this on a daily basis, I think we're just scratching the surface. So YCharts, very much the exception in terms of I know you guys are making a big push here and using this, but I think a lot of people are just so busy with their current jobs, they're not ready yet to think about, okay, how can I really implement this? But they will. Like it's coming. If it doesn't come from them, it's going to come from their employer telling them find ways to be more productive using this stuff.
Yeah, and I think there's a whole conversation to be had there around the fact that it exists and is actually usable and can create that value, right? There's a gap that needs to be closed. But this next chart I think is fun. So Charlie, we did a webinar probably 2.5 years ago, 2 years ago, and we talked about Nvidia, and I think they had just crossed $1 trillion in market cap. And I think we even did a poll and asked people if Nvidia would also be the first company to hit 2 trillion or something like that. And I think overall there was a pretty negative or bullish outlook on Nvidia kind of continuing this run and becoming or staying the most valuable company. But the run in their their profitability, their earnings, their stock price, everything has been amazing since we had that conversation.
It's been unbelievable. It's blown all of my expectations. I was 100% way too skeptical in terms of saying, how could this continue? And it now, in hindsight, it is the example of like if you go back in the history, we've never seen anything like this. Essentially, like 30,000% return in 10 years for a company, with most of that coming in the last few years. So yeah, it went from 1 trillion to 2 trillion to 3 trillion to 4 trillion. And just a few months ago, it hit 5 trillion, first company in the world to hit 5 trillion. And this would be the best argument I could say for saying, yeah, valuations are high, but Nvidia's valuation was extremely high a few years ago. And it was justified because look at what net income did. Like you're talking about 10x in a few years in terms of net income. Never seen a company goes from 10 billion to 100 billion in net income. We've never seen that, right, in a few years.
Yeah.
So, and I would still argue Nvidia has taken the lion's share of profits from this AI trade in terms of like all of everyone else's spending has been there accreted to their bottom line. So it does have to spread out, right, in terms of this spending has clearly benefited Nvidia. Now it has to benefit these other companies, and Nvidia has to maintain that 90+% market share, right, to keep this going. But this would be the best argument to say maybe it doesn't have to do Nvidia. It doesn't have to do Nvidia type growth. But if the S&P 500 were to grow its earnings at, let's say, I said it's 13% this year. If it could keep doing that for 5 years, like double the historical earnings growth for 5 more years, you can make a case. Yeah, it should be valued where it is because it's going to grow so much faster than it did in the past, right? And if you obviously if you think it's going to grow 20% a year, maybe the market's cheap, right? Right here. So that's the best justification that simply people are underappreciating the future earnings growth of the S&P 500 today, even with the valuations. They're underappreciating.
Hard to grasp that. But another one, right? So in past kind of bubble scenarios, you usually see a run up in IPOs, right? Companies kind of sprinting to get those public valuations and capitalize on those big valuations. We're not really seeing that right now. Maybe a little bit, but not seeing the same enthusiasm, right?
Not yet. I mean, it's creeping up. You could see 61 billion there. So, we have a few weeks left in the year. Maybe we get to 70, but we're not at the point yet like we saw in 2021. We had that crazy IPO and SPAC mania. We saw it in 99, 2000, right? Companies were rushing to cash in on that spike in sentiment. And the biggest companies associated with this, if we look at OpenAI or Anthropic or XAI, right? They're still private companies, and maybe they never go public in this cycle. But it's hard to believe that none of them are going to come public, Caleb, before this thing ends. So that's like, to me, this is maybe the best argument for the sentiment part not being there just yet. Like we're not at such a level where I know things have changed also between public and private markets, and there's many incentives for companies to stay private today. They have no problem getting financing and credit, right? All of that stuff that used to be a reason to go public, not to mention all of the extra regulatory hurdles that public companies face. So there's a lot of reasons to stay private, but I just feel like when this comes, you're going to see that wave like we saw in 2020 and 2021 with just like frothy companies that maybe aren't really producing very much yet. Maybe even if it's not OpenAI or those types of large companies, maybe these other companies will just come to market before this all ends. Maybe
Yeah,
it doesn't have to happen, right? Like look at 2007, right? Like that was a different bubble, right? It was a housing bubble related, but like the market still went down 50% from there. We had 65 billion. There was no what I'm saying is you don't need necessarily need an IPO spike to have a bear market, but I'm just questioning, can you have a real mania without like this huge flood of supply coming onto the market, right? Just like psychologically speaking, people are going to want to cash in, right, on that huge private market valuation. Like OpenAI is valued at 500 billion, I think, in the last round. I think it has 10 billion in revenue. So you're talking about 50 times sales. Like, yeah, maybe it goes to a trillion, but like someone's going to want to monetize that, I think, in the public. But maybe there's enough liquidity right now, and certainly they could sell their shares in secondary offerings in the private market. This is a tough one, but to me,
yeah.
this is the best argument for psychology, maybe not yet being there in terms of the bubble like activity we've seen in the past.
And Sean, I'm glad you brought up the private market component here because I think that is making a big impact on just a reduced need or desire for companies to go public or IPO at earlier stages when they can get access to so much of the capital that's available in private markets. But that leads to a point, right, where these, whether it's private equity or wherever that capital is coming from, eventually they need to return that return to
Yeah, and
their investors, right? And
there's crazy pressure. We've never seen private equity funds hold not do their distributions as long as they have. So now there's like, oh, you told me this was going to be 5 to 7 years, and now we're in year 8, 9, 10, and we're still holding these things. So when's it going to happen, right? And my
and
guess
this
is
chart
it's
to me
probably
is one
coming.
that I mean this could explode, right? Because it would only take one listing to have this be the biggest number on the chart here.
Yeah, for sure, right? Like it's like given the size that's in the private markets, and I think like it feeds on itself too, right? So like what we saw in 2020, you could see it was 169 billion, but like that number went way up in 2021 because people saw the valuations that these companies were getting. They said, "I want that too," right? So if you get a few early ones that start doing very well, now many of those ended very badly in 2022. If you look at the SPAC cohort from 2020, 2021, you're looking at 70, 80, 90% declines for most of those, and they never came back, right? So they didn't ultimately end well, but there was a period of time where these things were going up 20, 30, 40% a day after they came public, right? Just like a real mania. So that could feed on itself, and you could see just more and more issuance until it reaches such a level like it did in 2021 where it can't simply go any higher.
All right, so you got me nervous, and then you made me feel a little bit better. Um, but what can an investor do, right? What is a good strategy or a sound strategy in a market like this?
Yeah, so let's say you're worried, right? Yeah, let's say you're not making any crazy speculative bets. You're not using any levered leverage ETFs. You just have a normal diversified stock portfolio, which means you have a lot of exposure to the AI trade, even if you just have a diversified US portfolio. What I would say is if you're really worried about this, just assume it's a bubble. Like there's enough signs here that the bubble is at least forming. If it's not a full-fledged bubble, there are enough evidence to say that there's speculations going in the markets, valuations are high, all the rest of it. So you should assume that it could at any point lead to a bear market at any point. And that's true irregardless of whether we're in a bubble, right? You don't need a bubble to have a bear market. It can happen at any point in time, right? We had a bear market earlier this year, from February to April. People probably forgot about that. But so I would assume you're in one, which means one thing: you need to have enough bonds or cash to meet your liquidity needs in the short run. And by short run, I don't mean 4 months. Like the the bear market this year, for February, it peaked at 20% decline. By June, you're back at a new high. That no one's concerned about that type of bear market. What they're concerned about is things like '07, '09. It took 55 months, right, to get back to a new high. The dot-com bubble took 75 months, right? So things that are taking 5 years, 6 years, 7 years, it could happen. It's happened before, it could happen again. And if you have a liquidity need in the next few years, where you're going to be glad that you had something else in your portfolio so you don't have to sell the stocks that you have.
All right, what else?
Well, risk tolerance. It's like this is the term that everyone tries to define, but there's really no way to define it because everyone thinks about risk differently. The way I think about it, Caleb, very simple. Take the amount of equity exposure you have in your portfolio, whatever it is. Let's say it's 100,000. Okay, cut it in half. Say, how would you feel about that going down 50,000? If you have $1 million portfolio, how would you feel about that going down 500,000? If it happened in the past, it could happen again in the future. As Charlie Munger's said many times, you're going to have a few 50% declines in your lifetime. And if you can't handle that, then you can't be an equity investor. Now, I agree with that in terms of you can't be 100% in the equity market if you can't handle that. But if you have a 60-40 or 70-30, 40-30 portfolio, it's going to be different, right? It's just the equity part you have to cut in half and just say, will you be able to sleep at night? And if the answer is yes, fine. You may not have to do anything. If the answer is no, the time to do something about that is now. When you're in the bubble forming, maybe it's not a bubble, but we're at good levels. We've had multiple years of great returns. The S&P 500 has done 15% per year over the last 15 years. That's pretty good. It's 10% historically. We've done 15% per year for 15 years. So not a bad time if you're worried about it. And if you're not in that camp, you could disregard that. If you're worried about a potential big decline, get your risk tolerance right now. Don't wait until after the fact.
Timing's always a tough question though, right? Like even if you have that compelling emotion, you say, hey, like, pragmatically, I can look at this and say we're in a great spot. We've seen those big returns, but we could be missing out on, so much more. And we always talk about how bad it is to miss these best days in the market and how staying invested is always better than not staying invested. So how
In
do
the
you,
long run. Yeah.
Yeah, how do you balance those feelings with something like this that shows what these time periods tend to do?
Yeah, well, when people ask the question, are we in a bubble? What should we do? Like, and I'm worried about losing like, what they're really saying, and it's a valid question to ask, is can't we just sell now and buy back lower? And I would love to say yes. I would love to say I know this is the moment. This is March 2000. Get out now and at least wait for 20% decline or 30% decline before you could get back in. But we can't do that because people thought things were frothy in 1997. I mean, the rational exuberance speech was in 1996, right? The market kept going up a few more years after Greenspan made that speech. This could go on for a few more years. So you have to ask yourself, would you be okay missing out on 20%, 30%, 40% higher, right? The CAPE ratio is 40. Doesn't mean it can't go to 45 or 50. It certainly doesn't. If this is the most revolutionary technology of all time, Caleb, why wouldn't this ultimately have the biggest valuation of all time? Why wouldn't it surpass the dot-com bubble? It should, because the story will be better, right? So don't rule that out. And I'm not saying that's what you should assume or play for, but you have to ask yourself, will you be willing to sit that out, right, in trying to time it today? So I wouldn't recommend do that. I would recommend getting your exposure right so that, and for most people, that means having enough exposure where if it continues to go up, you'll be glad you didn't sell everything. But if it goes down, well, now you could use those declines to increase your risk exposure. And these are the times in this chart here that I get most excited for. And we did a webinar right around this time. It was in 2022. And the market was down 26% in 9 months as Wilshire 5000, looking at broad US index. And nobody at the time thought that these results would be similar to the past results when we had big declines. But here we are, 3 years later, 87% higher, right? So the real big gains are going to come, we know, during these periods of time. And so that's where I give people leeway in terms of, they say, well, should you never time the market? I said, well, if you're going to time it when the market drops a lot and things are on sale, but only do it with money that you're not going to need for 10 years, right? So if you look at the 10-year return column, pretty compelling. When the market has a big decline, usually 10 years later, it's much, much higher.
Indeed. But expectations maybe shouldn't be for that 87% 3-year return, right?
That's abnormal. I would love for that to happen, right? And we'll be talking about, we'll be asking the same question, right, in 2028. The name of the webinar would be, is this the biggest bubble of all time, right? We'll change it. And
But
realistically,
38% of our listeners would have been right. So
yeah, that's right. That's right. Now, what did they do about it? That'll be the question. But no, 15% per year is not a realistic long-term assumption. Could the market be up 20% next year? Of course, and even for a few more years. But we've been in an abnormal period, not unprecedented. Like we saw it during the 90s, we saw it during the 50s, where you had huge returns. But there's always reversion to the mean. There's always like another time period coming of low returns. We just don't know when it's going to happen. So set those expectations realistically, and you won't be disappointed when the market doesn't meet those high expectations.
all right, and at least one person chimed in with a question, which is, what about buying other things, right? You don't have to have all of your equity investments in the S&P 500 or even in U.S. large cap stocks, right?
100%. So we showed that chart earlier, the CAPE ratio, it's at 40. If we look at Mag 7 valuations, way, way higher than the broad market and much, much higher than the average stock. So if we look at small cap valuations, we look at international valuations, emerging market valuations, none of them are extreme compared to historical norms. It's really just the US large cap growth category. And even within there, looking at the Mag 7 type names. So the names most exposed to the AI trade. So let's just say it is the same as 2000. Caleb, let's play it out. This is an important point because this is showing you a 10-year period. But within this 10-year period, everything went down when the market peaked in March 2000. So in the short run, everything's going to be correlated if this is the top. You're going to see international, you're going to see small caps, you're going to probably see everything go down together in the short run. Now, if you play it out longer, what you'll likely see is the things that were most highly valued have the biggest drawdowns and have a longer recovery period than these other areas. And that's what happened during this 10-year period. You had things like REITs, emerging markets, small caps, not huge returns, but if you had a diversified portfolio with this stuff in there, you would have done okay. Even bonds were up 6% per year in the decade following the dot-com peak, where you had the S&P 500 down 1% per year. You had growth stocks down 4% per year. You lost about a third of your value in large cap growth from 2000 to 2009. And that was following, what people would argue at that point would be the biggest bubble in U.S. history, right? So a 10-year period, if you're concentrated, Caleb, in that asset that's the most highly valued, you lost about a third of your portfolio. If you were diversified, you probably gained ground during that period of time. So make sure you're really diversified just in case this is another bubble. We won't know until after the fact, but you can't wait until after the fact to diversify. Unfortunately, you have to diversify today. And I would argue, just looking at international this year, emerging markets, Europe up 30%, S&P's having a great year, no doubt, 17% gain, but it's not costing you much already this year. This is the first year in a while we've seen that, but
Yeah.
you're starting to see some benefits already to diversification, and we really haven't had any sort of pullback yet.
Yeah. It's an interesting point. It's a good reminder that, these risk premiums or, assets that we may view as riskier than the S&P 500 in times like this may actually, carry, more safety in a portfolio when they're playing their role.
Yeah, I'd argue diversification today is more important than ever before. Just going back to that concentration chart we showed. So if you got 40% of your S&P 500 in 10 stocks, you're really more dependent on those 10 stocks than ever before. So that's great if those 10 stocks do really well. It's not great if they don't.
Right.
So more important diversification today than when, let's say, those 10 stocks were 20% of the index. Not as important because you're already diversified, right, in owning the S&P.
All right, Charlie, I'm going to kick off our Q&A with the
Let's
asset
do it.
class that you left out of this chart, which is your favorite and one that we always talk about, which is gold. Gold's been interesting.
Gold.
How are you
Yes.
thinking about, a position like that
And
in
gold
a
had a
time
good
like this?
2000 and 2009, so it would have been represented well in this period. Um, we know gold has been on an incredible tear. It's best year for gold, up over 60% so far this year. Best year since 1979. 1979, Caleb, before you were born, right? Like you got
Oh
to go
yeah,
back a long time. And why is gold doing so well? Gold's a story asset, and it's really built on story more than anything else. And I think gold is doing well for a few reasons. Why is the story so compelling? It's the persistent debt and deficits that we continue to run, $2 trillion deficit to $38 trillion now in national debt. It's doubled over the last decade. So people are worried about that, the long-term implications of that. Perhaps we're going to have to print more money to pay for all of this stuff in the long run. That's going to lead to inflation. And I think people are buying gold in expectation of that. We're also seeing flows from central banks. We're seeing obviously speculation because of the big price increases. People are starting to buy the ETF and other things that are driving demand. How does gold do if this is a post-bubble scenario? I have no idea. Like this is a weird situation. It's very different than 2000 because in 2000 gold was down 50% from its high in 1980. So you look 20 years before that, gold was double what it was in 2000. So it was in a massively long bear market at that point in time. Then it's had a great 25 years since then, but a very different situation today. Gold's never been as high as it's been today, as it is today in terms of relative to inflation. And so, like, there's no way to value gold, but if you're going to try to value it, you would kind of look at how's it doing versus inflation, and we're pretty stretched there. So it's hard it's hard to make a compelling argument in that sense. But gold, as you know, I always say, gold is an enigma. It's not correlated to anything. If you want to have it in your portfolio, you have it because it behaves different than everything else in the long run. Sometimes that will be helpful. Sometimes that will be massively painful, as it was from 1980 to 2000.
Yeah, and we've seen plenty of visuals, even in just the webinars we've done together, Charlie, that just remind everyone the volatility, assigned with that asset that people think of as a store value sometimes. But I guess another question, right? So you've talked about inflation a couple times, and we talked about even how some of the spending that we're seeing is being funded by debt now. We've got another Fed decision coming up soon, and the potential for a rate cut. How are you looking at, the next Fed decision and the impact that could have on, this bubble or this, the stock market that we're looking at right now?
Yeah, so good question because back in 2000, the Fed at that point was starting to raise interest rates. So they were moving in the opposite direction. They were seeing speculative activity, they were seeing inflationary signs, they were raising interest rates. So, and they started that in 1999, actually. And here today, very different because they're still cutting rates. 100% they're going to cut next week. Like the odds are around 90%, but I think it's a done deal at this point. And I think it's a mistake. I'm in a small minority of people who say they shouldn't be cutting. Inflation is moving in the opposite direction of their target. They never hit the 2% target. It's unnecessary with the stock market at record highs, earnings at record highs, and inflation moving against their target. They shouldn't be fanning the flames of inflation once again. But they don't ask for my view, Caleb, and there's so much pressure from everyone else to say, keep cutting. Let's keep this game going. Yeah, the Fed made a mistake back in 2020 and 2021. We saw the highest inflation we've seen in 40 years, but that's behind us. Let's just forgive them for that, and let's just cut rates again. So, yeah, I think for sure you could put that in that pushback category, saying the Fed's not fighting this just yet. In fact, the market's expecting the Fed's going to keep cutting at least for another year. Now, we may get inflation data that changes their mind at some point, but it seems likely, at least definitely next week, and at least perhaps a few meetings next year, we're going to get more cuts before potentially they reverse course. So I would say all else equal, Caleb, and it never is. That would likely increase the speculation, increase the leverage, increase all of that risk appetite, increase the M&A, increase the IPO activity, all of that other stuff. So great question.
All right, let's do one more, Charlie, and it's another macro question. Coming a couple of times, and it's about how, right. So U.S. debt right now is about 125% of GDP, but household assets are also significantly, I think, lower, right, at 160 trillion, which is about 24% debt to assets. I think the question here is looking at just the difference in household leverage versus public leverage, and what your thoughts on that issue are.
Yeah, big difference. Households, thankfully, aren't behaving like the federal government and many state governments are, and which is to say they're not spending in excess of their means. You have a small group of people doing that, and we're seeing credit card delinquencies tick up, auto loan delinquencies tick up. We're seeing student loan delinquencies go up. So we are seeing signs of stress, but it's a small group that's representative, at least so far, right? It's not the same as what we saw back in the 2000s. And the mortgage aspect of it is completely home equity, credit, all of that stuff is very, very low levels. So I don't think it's a household debt issue or problem here that's going to cause issues for the broader economy. As far as the federal government, it's just kicking the can down the road. They're playing the game of getting elected. It's both parties. Nobody wants to be the one to be the adult in the room saying, we can't continue to do this. We can't continue to saddle our kids and our grandkids with debt and inflation. So we got to stop. Like nobody wants to do that because they want to get reelected. Let the next politician worry about it. And what I often hear, Caleb, and it wasn't in that question, but I'll address it, is why is the stock market doing so well if the government is running these massive deficits? Well, it's two entirely different things. Companies in the US have never been more profitable than today. Their profit margins are at record highs. They're doing the exact opposite of what the government's doing. They're being extremely efficient, extremely responsible. And so the stock market's a reflection of corporate earnings. And part of those corporate earnings are actually being helped from that deficit spending. And that's where it gets really crazy, right? And we saw the extreme example of that during 2020 and 2021, sent out the massive stimulus. Where did that money go? Some of it was saved, some of it was used to pay down debt, but a big part of it was spent. And who benefited from that spending? Apple. People bought more iPhones, they bought more iPads. All of the big companies, right, benefited from that government borrowing and spending. So in the short run, it's a boost to GDP, it's a boost to corporate earnings. It's only in the long run where you have to pay through it, either through inflation or you're going to have some type of crisis where you can't issue the debt. And since we're not at that crisis level yet, they're not going to address it. So it has to, my view is it has to become an actual crisis before they choose to solve it, because then they'll be coming in saying, we're going to save you from the crisis we created, essentially.
Yeah. Yeah. I agree with everything you said. And I think it'll also be interesting to see, if we do see a big shift in rates, if that consumer behavior changes when capital is a little bit cheaper and, also could be a way to refinance some of that government debt at a lower cost as well. But um, yeah, well, I know there are a few more questions here, Charlie. I think we're already a little bit over time. So maybe if it's okay with you, we'll wrap up here and answer some of the others offline, but wanted to personally say thank you. Always appreciate having you join and your insights. And this one was especially interesting. I think it's something that we've been hearing about a ton, and it's a topic that has far surpassed just the investing community and something everyone's talking about. So really appreciate your insights and thank you.
Yeah, for sure. Hopefully it was helpful. Thank you everyone for joining. And Caleb, always fun to chat with you.
All right. Well, thanks everyone, and have a great rest of your day and weekend and holiday season.